Good morning. It's Saturday, July 25th, 2020, 11:58 a.m. on the East Coast. This first video is about time frames. Topic came up in the trading lab on Friday about time frames. I think time frames are a very important topic for any trader or investor to have an understanding of and to delve into deeper. So what do I mean by time frames? Well, first of all, one can be bullish on a market over a multi-year horizon or time frame, but one could be bearish on a market over a 1 hour or 2 hour or 1 day or 2 day time frame. So markets are moving around all the time, and there's different trends and different levels of support, for example, depending upon what time frame you're looking at, what chart you're looking at. Okay, so for example, if you look at a 100-year chart of the Dow Jones, you see this amazing uptrend. So the stock market, the US stock market, is in an ultra long-term bull market uptrend. But could you realize that for any number of reasons, the stock market could have a really bad month like we had in March? So while the long-term uptrend slope is still very bullish, even after what we saw in March, I don't even like this drop, for example, in Apple, but look at the longer term slope of price action. It's a very strong uptrend. So while you might be willing to sell up here or hedge, you definitely be a buyer down around here. And if you were investing for 20-year horizon, you wouldn't trade it at all. You wouldn't buy or sell. You would just hold your position in Apple, for example, because this is the trend. And if you're investing for a 20-year horizon, it doesn't make sense to try and sell and buy back to try and save 10% because you might miss out on 100% or 200%. So this is a very important concept. 2008 looked like the world was ending. March 2020 looked like the world was ending. But look at these blips within the context of the long-term trend of Apple Corporation, Apple Inc. It's a blip. These are blips, but when they happened, it was like the world was ending. The media was in a fervor. People were fearful and afraid and selling at any price, right? But look at the long-term trajectory of Apple shares and the price action we see. This is $1 a share. It just almost reached $400 a share. Okay, so this is what I mean by different time frames. Probably the most important advice I could give to anybody is to have separate brokerage accounts. So you have one or two accounts for your long-term positions that you're not trading. Like, for example, we might own Canada Nickel or Banyan Gold in a long-term account that we are looking out 12, 24, 36 months, and we're not trading around a core position. We might hold Apple in an ultra long-term account, and we're not trading around the position. But in a separate brokerage account for our short-term trading, we might sell Apple. We might buy puts. We might take profits on a rally in Canada Nickel. We might take profits on a rally in Banyan Gold. We might buy a dip in either one of these stocks. We might buy the dip in Apple in March 2020, right? We have a short-term trading account that is deemed only for short-term activities. We do not confuse them in the same account. This is so important. Before I started doing this, I consistently mixed up my time frames. I would be bullish on something, then it would go up a lot, I would sell it, and then I'd buy something else or short something else or do something else. And I was just causing myself a lot of heartache, a lot more confusion than I needed to. If I am bullish on Canada Nickel, for example, and I'm thinking this is going to go to $10 a share eventually, maybe 2 years from now, why am I trying to trade around it and get cute to try and save 20 or 30 cents, right? But if I'm trading intraday in the stock market and I see that GDX, every time it gets way outside of its upper Bollinger Band on the 15-minute, it drops back into it. Why would I not take advantage of this and trade it in a separate account to make some profits to pay my rent or to go out to dinner, right? But I shouldn't confuse these trades on the 15-minute with the breakout on the monthly chart from a massive head and shoulders bottom, an 8-year bottoming process that just completed and is now breaking out with tremendous force. No, I want to keep this position. I want to stay bullish on gold miners long term. But shorter term, in my day trading account, I might be shorting, I might be buying back, I might be selling, I might be doing all kinds of stuff. I might be buying stock and selling calls against it. I might be buying puts. Who knows, right? I might be doing all different sorts of strategies in my day trading account. But in my long-term position or my retirement account, I'm ultra long because look at this breakout from a multi-year, an 8-year bottom. An 8-year bottoming process doesn't end in 3 months, okay? This has a lot of potential energy stored up in it. And I would say GDX is going to get to at least $50 this year at some point. But could I short it at 41.83 in my day trading account? Because I think it's going to drop back to 41 or 40.75 or something. Sure, I can do that. This is when I bought Dust, right? I bought Dust here. Pretty good trade. But that's a day trade. That's a 15-minute chart that doesn't have anything to do with the monthly chart. And this is the really important point. Don't confuse your time frames. A lot of guys out there, especially older guys, they just want to talk about one time frame. They're always bullish, right? They're always long. And they try to make other people fearful of taking profits. But honestly, they don't know what your time frame is or what you're talking about. They don't listen to anybody else tell you what you should do for yourself on your time frames and what you're investing for, what you're trading for. Nobody knows what your objectives are. Only you do. And so that's why asking people for advice, what should I do? I can't answer that. It depends upon your investment objectives, your risk tolerance, your income level, your age, the age you plan to retire. I mean, there's so many questions. So you need to answer those questions for yourself. And you can use other people's analysis of markets and charts to help inform yourself so that you can generate your own answers. But my least favorite question to get on any investment chat or from my subscribers or from a blog post is, what stock should I buy now? Or do you think I should sell gold here? Do you think it's too overbought? I hate those questions because I don't know. First of all, I don't know. That's number one. Why do you think I know what you should buy, right? Number two is I don't know what your investment objectives are. I don't know what your risk tolerance is. I don't know what your income level is. I don't know how old you are. A whole bunch of slew of questions that need to be answered. And that's why all the disclaimers on investment sites have to do with consult a registered investment advisor, et cetera, et cetera, et cetera. Because there's a lot of sense in meeting with a registered investment advisor and going through all of these questions and coming up with a game plan, a long-term game plan. Day trading is completely different from long-term investing. The two have nothing to do with each other, except for they have to do with buying and selling stocks at some point in time. Day trading is not investing. Trading is trading. And I can be a trader and an investor in the same brain and heart. The same human being can both have investment objectives and investment accounts and be a day trader and trade shorter term in a day trading account. But please, and I'm going to say this for the 100th time in this video, have separate accounts. Make your day trading completely distinct from your long-term investment positions, and don't get them confused. And if you don't have enough money to do this, then decide what you are. Decide, are you an investor now or are you a trader now? And then don't get them confused. And if you're a trader, don't listen to investors talk. If you're an investor, then you probably don't care what my day trades on the S&P 500 are, right? But I can also talk about investing in a different conversation because I'm an investor too. But during market hours, I'm usually wearing my day trading cap, right? And this is the distinction. I think this is a really important concept, a really important video. I can be completely bullish on this chart and this market on the monthly or weekly time frame. This is a powerful breakout from an 8+ year basing process. And people are just starting to take note of it. But on this 15-minute chart, I look at these bearish divergences on these marginal new highs. The relative strength is waning as this market is making marginal new highs. And then outside the upper Bollinger Band, printing a topping candlestick, and I'm short. So I'm shorting this on the 15-minute time frame, but in my investment account, I'm still long. I'm not touching it. I hold physical gold. I hold physical silver. I'm invested in gold mining stocks and junior explorers in my investment account. In my day trading account, I can short GDX. I could buy dust, right? And that is the distinction of time frame. So when I'm day trading, I'm looking at 5-minute charts, 15-minute charts. When I'm investing, I'm looking only daily, weekly, monthly. Only, period, end of story. Hopefully this wasn't too long. Feel free to ask me any questions. Have a great weekend. I'll see you in the trading lab.